Every country on Earth owes money. The United States, China, Japan, Germany, Brazil. No matter where you look, the numbers are just staggering. Trillions in government debt, even more in corporate and household borrowing, and honestly, the total global debt is now more than 3 times the size of the world's entire economy. But if every country is in debt, who is actually owed? Who owns the money? And what does it mean for the future of nations, currencies, and, well, ordinary people? To answer that, we have to start with a simple but honestly unsettling truth. Debt is not just a number. It's a relationship, a promise to pay, a claim on future wealth, and a tool that has shaped the rise and fall of empires for thousands of years. The story of global debt is really the story of power, trust, and the hidden architecture of the financial world. Let's go back to the birth of modern government debt. In the late 17th century, England was fighting expensive wars and needed a new way to raise money. The solution was the creation of the Bank of England in 1694, which allowed the government to borrow from private investors by issuing bonds, essentially IOUs that promised interest payments in return for cash today. This was, honestly, revolutionary. For the first time, a government could finance itself not just through taxes or plunder, but by selling its own promises to the public. The idea spread quickly. France, the Netherlands, and later the United States all built their economies on the foundation of government debt. But here's the twist. The people who bought those bonds weren't just ordinary citizens. They were often wealthy merchants, bankers, and foreign investors. People and institutions with the power to shape policy and demand repayment. Over time, the holders of government debt became a shadowy class of creditors, often invisible but always influential. Wars were fought, governments rose and fell, and fortunes were made and lost, all on the back of borrowed money. Fast forward to the 20th century, and the system had grown even more complex. After World War II, the United States emerged as the world's financial superpower. The dollar became the global reserve currency, and U.S. Treasury bonds became the safest asset on Earth. Countries around the world began to hold dollars and U.S. debt as a way to stabilize their own economies. But this created a strange paradox. America owed money to the world, but the world depended on America's debt to keep its own financial systems afloat. Today, the web of global debt is more tangled than ever. Governments borrow from their own citizens, from foreign countries, from banks, and from mysterious institutions like hedge funds and central banks. Corporations borrow from each other, from pension funds, and from the public. Even central banks, supposedly the lenders of last resort, hold each other's debt in a dizzying circle of promises. The result is a world where everyone seems to owe everyone else, and the true owners of the money are hidden behind layers of contracts, funds, and offshore accounts. But if everyone is in debt, who is actually in control? Who owns the money, and what happens if the system breaks? In the next part, we'll peel back the layers and reveal the real power players behind the world's debt, and what their control means for the rest of us. If every country is in debt, who is actually holding the IOUs? Who are the real creditors, and how much power do they wield over nations and ordinary people? The answer is both simple and deeply complicated, because the true owners of the world's money are often hidden in plain sight, operating behind the scenes of the global financial system. Let's start with the most obvious players, central banks. These are the institutions, like the US Federal Reserve, the European Central Bank, the Bank of Japan, that create money, set interest rates, and act as the ultimate backstop for their economies. But central banks don't just print money, they also buy and hold vast amounts of government debt. In the United States, for example, the Federal Reserve owns trillions of dollars in treasury bonds. In Japan, the central bank owns so much of the government's debt that it has become the single largest creditor in the country. This means that, in a sense, governments owe money to themselves. But it's not quite that simple. When a central bank buys government bonds, it creates new money out of thin air, money that flows into the economy, inflates asset prices, and can eventually lead to inflation or even currency crises if not managed carefully. But central banks are only part of the story. A huge share of government debt is held by private investors, banks, pension funds, insurance companies, mutual funds, and hedge funds. These institutions buy bonds because they are considered safe, reliable investments. They use them to back up their own promises, to retirees, to policyholders, to shareholders. In many countries, pension funds are among the largest holders of government debt, meaning that the savings of millions of ordinary people are directly tied to the ability of governments to pay their bills. If a government defaults, it's not just faceless investors who lose out, it's workers, retirees, and families. Then there are the foreign creditors. You see, countries don't just borrow from their own citizens, they borrow from each other. Take China, for example. It holds more than $1 trillion in US Treasury bonds. Japan, well, it holds nearly as much. European countries, on the other hand, hold each other's debt, creating this intricate web of mutual dependence. This situation gives foreign governments enormous leverage. If, say, China or Japan decided to dump their US bonds, it could definitely send shockwaves through global markets. But of course, doing so would also hurt their own economies, since the value of their reserves would plummet. It's quite the delicate balance of power, where everyone is both a creditor and a debtor, and no one can afford to pull the plug. But, the real power players are often even less visible. Hedge funds and private equity firms, operating out of tax havens and financial centers, buy up distressed debt from struggling countries and companies. They use legal maneuvers and political pressure to extract payments, sometimes forcing entire nations to choose between paying creditors and providing basic services to their people. These so-called vulture funds have made billions by betting on the collapse of countries like Argentina, Greece, and Puerto Rico. Their influence is rarely discussed in public, but believe me, it is felt in the lives of millions. And then there's the role of the International Monetary Fund, or IMF, and the World Bank. These institutions were created to stabilize the global economy, but their loans often come with strict conditions, demanding austerity, privatization, and economic reforms that can devastate local industries and social safety nets. In many cases, countries end up borrowing just to pay off old debts, trapped in a cycle that benefits creditors while ordinary people bear the cost. So, who really owns the money? The answer is, well, a shifting alliance of central banks, private investors, foreign governments, and powerful financial institutions. They are the creditors who hold the world's IOUs, the ones who decide when to lend, when to collect, and when to cut their losses. Their decisions shape the fate of nations, the value of currencies, and honestly, the lives of billions. But what happens when the debts become just too large to pay? What happens when the system is stretched to its breaking point and the creditors start to worry that, they might not get their money back? In the final part, we'll explore what happens when the world's debt bubble bursts and who stands to gain, or lose, when the music stops. What happens when the debts become too large to pay? What happens when the world's financial system, built on layer after layer of promises, finally reaches its breaking point? The answer is not just a matter of economics. It's a question of power, survival, and honestly, the future of money itself. Throughout history, debt crises have been the trigger for some of the most dramatic turning points in civilization. When the debts can't be paid, the system doesn't just quietly reset. It explodes. Currencies collapse, governments fall, and ordinary people are left to pick up the pieces. The winners and losers are rarely who you expect. Take the Latin American debt crisis of the 1980s. For years, countries like Mexico, Brazil, and Argentina borrowed heavily from foreign banks, encouraged by low interest rates and easy money. But when the US Federal Reserve hiked rates to fight inflation, the cost of servicing those debts soared. Suddenly, entire nations were unable to pay what they owed. The result was a lost decade, soaring unemployment, collapsing currencies, and waves of social unrest. The banks that had made the loans were bailed out by their own governments, while ordinary citizens faced austerity, poverty, and political chaos. Or look at the Eurozone crisis of the 2010s. Greece, Ireland, Portugal, and Spain found themselves drowning in debt after the global financial meltdown. The European Central Bank and the IMF stepped in with rescue packages, but the price was steep. Public spending was slashed, pensions were cut, and millions lost their jobs. The creditors were paid, but the people paid the price. The lesson is clear. When the debt bubble bursts, the most vulnerable are often left holding the bag. But it's not just developing countries or small economies that are at risk. Today, the world's largest economies are more indebted than ever before. The United States, the European Union, China, and Japan have all piled up mountains of debt, betting that growth and low interest rates will keep the system afloat. But what if that bet fails? What if inflation surges, interest rates rise, or trust in the system collapses? The consequences would be global, and honestly, pretty devastating. In such a scenario, the first to suffer are usually those with the least power: workers, savers, and pensioners. Inflation erodes the value of wages and savings, while asset prices can swing wildly. Governments may respond by printing more money, imposing capital controls, or even seizing assets. In extreme cases, currencies can become worthless overnight, as happened in Zimbabwe and Venezuela. The wealthy and well-connected often find ways to protect themselves, moving money offshore, buying gold or real estate, or investing in foreign currencies. But for most people, the options are, well, pretty limited. Yet, every crisis also creates opportunities. When the old system collapses, new winners emerge. In the aftermath of the 2008 financial crisis, for example, those with cash and courage bought up distressed assets, real estate, stocks, even entire companies, at bargain prices. The same pattern played out after the Asian financial crisis, the Russian default, and countless other meltdowns. The key is to recognize the warning signs early, diversify your assets, and be ready to act when others are paralyzed by fear. But perhaps the most important lesson is that the future of money is always up for grabs. When trust in the old system collapses, people look for alternatives. Sometimes it's gold or silver, sometimes it's foreign currency, and sometimes, as we've seen in recent years, it's entirely new forms of money, like cryptocurrencies. Bitcoin and other digital assets have emerged as a response to the perceived instability of traditional finance, offering a way to store value outside the reach of governments and central banks. Whether these new forms of money will survive the next crisis is still an open question, but their rise is a sign that people are searching for something they can trust. So, if every country is in debt, who really owns the money? The answer is those who hold real assets, those who control the levers of finance, and those who can adapt when the rules change. The global debt system is a web of promises, but when those promises break, it's the prepared, the flexible, and the informed who come out ahead. History teaches us that debt is both a tool and a trap. It can build empires, but it can also destroy them. The next debt crisis is not a matter of if, but when. The question is, will you be ready? Will you understand who really owns the money and how to protect yourself when the music stops? If this video gave you a new perspective, make sure to subscribe and share it with someone who needs to hear the truth about our financial system. History has the answers, and I'll be here to show you where to look. Stay informed, stay prepared, and remember, in the end, trust, not paper, not digits, not promises, is the only real currency that survives.